All right, so what's up, guys? I'm trading patiently. As you can see, we have the camera set up now. I'm trying to improve the quality. One video a week, every single week. Expect that consistently. If you're new to this channel, go down below, subscribe. If you find the videos insightful or valuable, share them with your friends. Literally all I ask, and it takes 2 seconds. In this video, we are going to be talking about external and internal range liquidity. It is the absolute easiest way to get your drawn liquidity every single day, and I'll show you how easy it is in this video. I'm trying to keep this one short and concise, sweet and to the point, like all my content. So with that being said, let's get right into this video. External and internal liquidity is the very first thing I'm filtering for every single Sunday, and it is the basis of everything that I do. If there is no clear drawn liquidity, if there is no clear one-sidedness, I'm not trading that ticker or pair. It's just as simple as that. So as some of you may know, price only does two things. It either seeks liquidity or offers fair value. That is all price is ever doing. It's either drawing to inefficiencies in price, like fair value gaps, imbalances, whatever you want to call it, or it's seeking old highs and old lows, or liquidity pools. That's all price is ever doing at all times. And once you begin to see the market this way, it's absolutely game changing. IRL is offering fair value, and ERL is seeking liquidity. Go into your charts, look for yourself. I promise you at all times, it's either seeking liquidity or it's offering fair value. So first we have ERL, which is external range liquidity. ERL is liquidity pools, old highs or old lows, swing points. Any of those. You can define it as any of them. It's the same thing. So when I'm looking at my charts, I'm looking for swing points. If you look at a previous candle high or a previous candle low and drop to a lower time frame, there's always going to be a swing point there, which is an old high or old low. So it's all the same thing, but I just define it as swing points. So price is always drawing to these liquidity pools. It's either offering fair value or it's drawing to these liquidity pools. Next is IRL. This is internal range liquidity. IRL is inefficiencies in price or imbalances in price, and that can be simplified to fair value gaps. So ERL, swing points, IRL, fair value gaps. Sweet, short, simple. The best way that I can explain inefficiencies in price is like a paint roller. So say that we have a paint roller and we dip it in paint and we're going to the wall and we're doing one continuous stroke down the wall. Eventually we're going to run out of paint, right? And there's going to be this little blank mark on the wall because we ran out of that paint. That is exactly like price. So picture price as a paint roller. It's painting price. And when we displace and push with energy, it creates these inefficiencies in price, and it needs to go back and get more paint before continuing to paint. That's the best way that I can explain it. Hopefully that makes sense. So when price creates these inefficiencies or imbalances, it's going to want to go back, refer to them, redeliver to them, and then it's going to continue delivering in the direction that it just was efficiently. And that's what price does constantly. It's offering fair value, and then it continues to seek liquidity. These inefficiencies in price are internal range liquidity, and once price seeks internal range liquidity or offers fair value, it's going to now seek liquidity over and over and over again, like clockwork, okay? It's beautiful when you see it in the charts. Now you're probably wondering, how do I use ERL and IRL? How do I apply this concept? I personally use ERL and IRL every single Sunday, and I use it as a filtering process. So what I mean by that is I go through the monthly, weekly, and daily, and I filter for external range liquidity or internal range liquidity on those time frames. When I have those and I can see a very clear internal to external move or external to internal move in the direction of the order flow, I know that there is a very clear and obvious draw on liquidity for that pair, and that's something that I want to focus on. So I add it to my list of interest, and then that's something that I'll be focusing on throughout the week. So some of you may know every single Sunday I go through and I do that filtering process with external and internal on live streams, and I show the exact process that I go through. So definitely tune into my Sunday live streams where I go through this process. That's really all I do. I filter MWD, monthly, weekly, daily, for ERL and IRL. Clear and obvious draws and liquidity on pairs. And if they do have that very clear draw, then I'll add them to my list of interest and I will focus on them that week. This gives us our draw on liquidity. So we understand where the higher time frame is drawing. And then within these contexts, ERL to IRL or IRL to ERL, that is where our market maker model forms. And when we have this boundary to operate within, that's where we execute on the market maker models. So at this point, you're probably wondering, how do I apply this concept? How do I apply this logic to the charts? Here is your step-by-step guide on how to use ERL and IRL. Mark out your most recent swing high to swing low. This gives you your current price leg. You always want to be looking for internal fair value gaps. You want price legs that have fair value gaps in them. Now that you have that most recent swing high to swing low marked, mark out the fair value gap within that price leg, and then ask yourself, is price offering fair value, aka drawing to the fair value gap, or is it seeking liquidity or drawing to the external range, liquidity on the outside of that range? That's all you have to do, bro. That's literally all it takes to get a very clear draw on liquidity. And if you have that on the weekly or the monthly, you have an entire month or week of a clear and obvious draw on liquidity. So you want to be executing on that the entire week or month. You know, as long as that context, as long as that draw on liquidity is there, you want to be executing in that direction. So it gives you a bias for the entire week or the entire month. That is why this concept is so beautiful. And the best part is it's so damn simple. The last thing I want to make very clear is once you have this context, aka internal to external or external to internal, you want to trade until that context is taken. So within that IRL to ERL or that ERL to IRL, that is where these market maker models form, and you want to trade the models until the context is gone. If there's no context, there's no trade. So if you don't have context on the monthly, weekly, or daily, there is no obvious draw on liquidity, aka there is no context, so you have no trade. I'm not focusing on a pair that doesn't have a clear draw. Simple as that. Now, really quickly, I'm going to show you guys some examples in the charts of external and internal range liquidity. So here we are looking at AUD CHF on the weekly time frame, Australian dollar, Swiss franc, and going back to that ERL IRL checklist I gave you guys, the very first thing that we want to do is mark out the most recent swing low to swing high. Now, I already know what you guys are going to say. Cam, there's no swing high that formed here yet. And technically, yes, you are correct. But when price creates these new highs like this, we have the swing low right here that we marked. That is a very clear swing low. It's already formed. When price creates these new highs like this, it's eventually going to pull back and trade towards fair value. So we're pretty much just anticipating that swing point to form. So once we get this swing low and price creates these new highs, we're just expecting this swing high to get put in eventually. So the very next thing that we do is mark out the fair value gap within that price leg. So we have our most recent swing low to swing high, and then we have the fair value gap within it. So we have external and then internal. So external, external, and then internal. Now, like I said, price is eventually going to pull back and offer fair value before continuing higher. So as we can see here, price pulls back to that fair value gap. This is that internal range liquidity. So we had that draw to internal. Now, during this time, when this weekly candle was forming and drawing to this weekly fair value gap, the fair value gaps on the 4-hour, the daily, they were pointing in this direction. The fair value gaps on the lower time frames were showing intention towards this weekly internal range liquidity. Now that we've hit this internal range liquidity and this order flow is bullish, we are expecting price to now seek liquidity. So we've offered fair value. Now we will seek liquidity. So at this point, this is where we have a very clear draw on liquidity on AUD CHF from IRL to ERL. So we're looking to operate within this context. Within this context, this is where the market maker models form. You know, within this arrow, from this fair value gap to that external range liquidity, this is where the market maker model forms, and we're looking to trade that the entire week in that direction. So this entire weekly candle, we have a draw on liquidity. So let's just watch this play out. Look how this candle closes, respecting that fair value gap. So going into that next week on AUD CHF, I would be bullish bias the entire week, and I'm looking to trade in that direction the entire week. So this is a very clear weekly context that we're looking for a market maker model to form within. This gives us a very clear bias for the entire week. Now let's just watch how this plays out. Boom. Draws directly to external range liquidity. Yes, we did wick lower. It swept this liquidity, but the wick did the damage and the bodies told the story. So we respected fair value, and then we now seek liquidity. Offer fair value, seek liquidity. Seek liquidity, offer fair value. Every single time it does that. It never does anything else. It's either seeking liquidity or offering fair value. All right, so here we have NZD CHF on the monthly time frame. As we can see, very clear bearish order flow. So we want to submit to that trend. We want to expect price to continue lower. But like I said in the last example, price is not just going to continue to go down. It's not going to go down forever. It needs to pull back, offer fair value before continuing to seek liquidity. It needs to redeliver to these inefficiencies in price before it continues to seek liquidity. So if we look on the monthly and we look at our most recent swing high to swing low, yes, it's a huge price leg. You know, I wouldn't expect price to trade all the way up here, but let's mark out our inefficiencies within that price leg. So where's our inefficiencies in price? Right here. This is our imbalance in price, our inefficiency. This is our bearish monthly fair value gap. And price is going to eventually pull back and offer fair value before continuing lower and seeking liquidity. So now let's watch this next monthly candle. Price obviously drew to that fair value gap on the monthly. You know, it was offering fair value on the monthly time frame. So on the daily, on the 4 hour, those fair value gaps are going to point in that direction, and we had a very clear draw to that monthly fair value gap the entire month. Now that price has offered fair value on the monthly, what do we expect it to do? We expect it to seek liquidity, and the trend on the monthly is bearish, so we expect it to continue lower and seek that sell side liquidity lower. What does price do? It rejects the order block, fair value gap, and begins to seek the sell side liquidity lower. So that entire month, we have a very clear draw to that monthly sell side. If we drop into the weekly, price is fractal, so we can see the exact same thing. Price moved from internal on the monthly to external on the monthly. Now, what do we have on the weekly? Now that we've swept these lows, this is our external range liquidity on the weekly. We mark out our most recent swing high to swing low. This will be a swing low as it pulls back. You know, don't worry too much about that. This is the current price leg. That's what you always want to mark out, the current price leg. And then mark out the inefficiency, the fair value gap within that price leg. Now that we have the most recent swing high and swing low on the weekly, ask yourself, what did price just do? Where is price drawing to? Is it seeking liquidity or is it offering fair value? External or internal? Price very clearly just took external on the weekly time frame. So now what is it going to do? It's going to seek internal range liquidity. So now this entire week, we have a bullish bias to that weekly internal range liquidity. So from external to internal. And as you can see, price delivers to that internal range liquidity before potentially delivering lower. So yeah, hopefully those examples helped you guys. I wanted to give you a couple chart examples so you could see it and how it works in real time and how you can apply it. So when we have those weekly or daily contexts or even monthly contexts, those ERL to IRL moves, IRL to ERL moves, we have a bias or draw on liquidity for that entire month, week, or day. It's very, very important that you use this as a filter. And like I said, every single Sunday, I do this on live streams. So make sure you tune into that. With that being said, that's really it for this video. I hope you guys did enjoy. If it was insightful, if it was valuable, please share it with your friends, drop a like, subscribe if you're new, all that stuff. That's all I'll ever ask, and it takes 5 seconds. It's completely free. So if you could do that for me, thank you so much. And yeah, that's really it for this video. I hope you guys did enjoy. I'm out.